And I'd like to start with certain headline numbers. Our revenues for this quarter were at 988 crores, net profit of 81 crores and EBITDA of 246 crores. When you compare this to FY17 numbers, I would like to basically put this in context because FY17 numbers had a one-time adjustment of IND-AS due to the migration of our accounting system to IND-AS. And if you were to correct for IND-AS adjustment, our revenues registered a 3% growth year on year. However, factoring IND-AS, it was a 4% decline. Similarly, net profit was 51% decline as against a 42% decline if you adjust for IND-AS. And EBITDA showed a decline of 19%, but adjusting for IND-AS, it was a 9% decline. Now, therefore, overall, our top line and bottom line had a soft quarter this year. But let me also mention that this was also on account of a number of factors. The most significant of these factors was, of course, the inclusion of operational and fixed costs pertaining to Malaysia. And this actually has impacted bottom line significantly. This is something which we have already shared with you in the past. So this year's, PAT numbers and EBITDA numbers obviously do include these particular operating costs. Now, when you look at the top line, I think we have had several impacts. One, of course, being attributed to a weak dollar. Considering the fact that almost 70% of our revenues are dollar denominated, we've seen a significant hit there. GST impact was specifically, isolated for this quarter, where really only our India-centric business, largely our branded formulation business and some sales to India were actually impacted because of GST. But we believe this is going to recover in the coming quarters. When you look at other factors, we also believe that we've seen some sluggish performance in our small molecules. But having said that, I think we have seen a very, very robust performance in terms of our biologics, largely from our insulins business in emerging markets, where we have seen a 15% increase in biologics, and if you adjust for IND-AS, I think it's a 27% increase in our biologics business. So this is a very healthy trend. Biologics is a very positive trend. Having said that, yes, we've seen a decline in our small molecules business. Licensing also was much lower than last fiscal, but as you know, licensing income is lumpy, and therefore that has also affected our performance this quarter. Our EBITDA margins were at 25%, but when you look at our core EBITDA margins, it was again at a very healthy 29%. And when we talk about core EBITDA, this is really excluding the licensing, impact forex and R&D expenses. So when you look at those core operating EBITDA margins, it is a healthy 29%. Coming to R&D, R&D stood at 58 crores this quarter, which is a net increase of 13% year on year. And at a gross level, R&D spends were at 96 crores, largely on account of several of our biologics programs. This quarter was also impacted by our incremental, salary costs, which actually kicked in this quarter. It increased 18% to 193 crores this quarter. As I mentioned, interest and depreciation costs were much higher than last year. It is 60% higher than last year at 115 crores, largely attributable to our Malaysia facilities. Now let me come to some of the milestones that I'd like to really talk about. So I think the most significant milestone was certainly the the recommendation from the ODAC, or the Oncologic Drug Approval Committee of US FDA, for our biosimilar trastuzumab. And what's more, it was actually a recommendation that included extrapolation of data for all eligible indications for trastuzumab. So I think this positions us very favorably for marketing approval by US FDA, and we are awaiting that final approval. We also have received, marketing approval from the Drugs Controller General of India for our biosimilar bevacizumab, which we will launch very shortly in the Indian market. Having also bevacizumab phase 3 trials continues to make progress in terms of our global phase 3 trials, and so we are on track in terms of these clinical trials. We also presented our clinical trial data of insulin glargine at the American Diabetes Association at their 77th scientific session in San Diego earlier this year. As I mentioned earlier, the biologics business has actually registered a 15% year-on-year growth to 184 crores, but really after adjusting for Ind AS, it is actually 27% year-on-year. We expect our biologics business to remain strong given the kind of expected regulatory approvals in many emerging markets. We have also made regulatory submissions for our biosimilar trastuzumab to both Canada and Australia and some other emerging markets, and we expect the review process to be underway. I would also say that in terms of our small molecules business, we are commissioning our solid oral dosage facility for our formulations business very soon, and so this will also help us to basically forward integrate our APIs business to finish formulations, ANDAs, and that's a business that we will basically ramp up over the next fiscals. In terms of our novel program, our IN-105 insulin tregopil program is set to enter both phase 3 clinical trials for type 2 diabetes and a phase 2 trial for type 1 diabetes. Our immuno-oncology asset is also making good progress. Our fusion antibody, first molecule is entering, is already in advanced preclinical development and will enter clinic by the end of this fiscal or early next fiscal. Branded formulations, as you know, has been hit by GST this quarter, but is expected to recover starting next quarter. Also, I must mention here that Q1FY18 also did factor in Abraxane, which has since been dropped as a brand by this division. We have also rationalized a lot of our businesses, and therefore going forward we want to meet plan as this is a business which we want to really focus on as a specialty business. Research services has had a softer than expected quarter, largely because of the fire impact that Syngene has had to deal with. But going forward, Syngene is extremely confident that it will have a double-digit growth starting Q2, and they're already seeing an uptick in their order book. I think some very important notable highlights for Syngene this quarter were the expansion of its agreement with Amgen and the manufacturing agreement that it has entered into with the Japanese pharma company to manufacture and supply a novel chemical entity for which it has been involved with this company right from the proof of concept stage. So it came in at revenues of 291 crores this quarter, which is up 6% over FY17, and it also came in with 62 crores of PAT this quarter. So in conclusion, I would say that although we've had a soft quarter, largely impacted at the bottom line by Malaysia carrying costs, we are looking at improving revenue numbers going forward based on a number of expected tenders and other emerging market opportunities that we are addressing. So I will stop there.
Right, so that was the management of Biocon addressing the earnings conference. It has been a weak quarter and the stock is reflecting that. However, there's been some recovery from the day's low point. Syngene has also reported the stock was initially reacting positively, but that's about Biocon. The margin was at 25% and there has been some pressure that has been witnessed in this quarter, and even in terms of the branded formulations business from the GST destocking standpoint, as well as, I mean, we've seen it with other pharmaceutical companies also. But let's welcome in our guest market guru for today. We've got Mr. Sampath